Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. She is a tax expert for individuals and small business owners. And we were just talking before the break about the seminars that she's going to be doing coming up and some of the topics you're going to be covering. You know, one of the areas for you right now, in particular with the new tax laws and that, is this one of the things that you're looking to get into, is how this is going to affect all these different areas? Well,
absolutely, because I think 18, since we have just as of August 8th got the last updates, it's going to be a hard year, so any kind of changes or adjustments you need to make, it's going to be relatively quick. So that's why we're having all 4 of these in September, giving them in the last quarter, hopefully, to make some changes. But, you know, to be quite honest, we're going to probably end up doing 18 taxes and figure out, but it's big changes. You know, I mean, capital gains rates, for example, are still 15%. Which used to go along with the code, but now we're at 12%. People that have rental properties, now we have the QBI 1099, 199As, meaning there's a credit out there that's going to apply to people with rental properties that show profits, which many people, if you've paid down most of the mortgages and things, you can end up with showing profits. If you have a small business, I mean, all these have a big effect on individuals, how the tax code's going to come back. You know, is it time to do not so much financial planning on my side? I don't do Hank's job. I'm not a financial person. But if somebody is in consideration that they're on Social Security only, haven't had to file taxes, maybe it's time to consider doing a Roth conversion if you have an IRA or something. Those kind of little things. But most of the things we're going to be looking at is we've had the biggest tax change in 30 years. So we're going to break it down. It's an hour-and-a-half seminar. We're going to go pretty much step by step. We're going to have a lot of examples showing people, hey, if this is kind of the scenario, this is the new tax versus what you would have paid in the past. Maybe at that point, as we've covered on the show today, you might want to contribute a little bit more money. If you're saving it, maybe you could actually save it, you know, put it someplace where, you know, you living off the same dollar amount anyways, but maybe you're getting a $2,000 refund this year because of the new tax law. Wouldn't it be great to put that into an IRA or a Roth or into more 401k, whatever, and still have a little bit more money and not change your lifestyle at all? So that's the kind of things we want to consider.
This is one of the areas when it comes to taxes and planning. There are a lot of Friday mentioned about capital gains tax. This is another one of understanding how those work. So I'll give you a little tip, and there's going to be even more in-depth coverage there, and that's why I say I may sneak in and just kind of kibitz a little bit and, you know, throw in my 2 cents here. At least on not too far away.
Yeah. So he'll be at the Brentwood location.
When I'm in town. Here's an example of that. Yeah, Brentwood would definitely be up my definitely be that one. One of the things to look at is capital gains. Is understanding how these rules work, okay? So if you're in a 12% bracket, as Dr. Fry said, they were, like last year, a 15% bracket, okay, 0 tax. You cross over, then you got the 15% tax. So in that situation, we cross into a 25. So now this year, if you're in a 12% bracket, up to, again, married couple up to, you know, $100,000 AGI, and you're still in that 12% bracket. Now understand though, if you have then a gain on top of that, that gain is going to push you into the higher bracket. Now what that means is you just went from, if you stay, let's say you had a gain and you stayed under 100,000 total income, then 0 tax on that gain. However, if the gain pushes you into the next bracket, 22%, now you're going to have a 15% tax on that gain, and up to the top bracket, at which it would be 20. It would go up to 20%. And then you've got the surtax as well.
Yeah, you have the 3.8% tax. That's a surtax on top of that. If anyone that makes 200 as a single or 250 as a married. And the problem is also the tax code doesn't comply. So the 12% is actually $77,400. That's the 12% for ordinary income tax. For capital gains rack, it's $77,200. So there's a $200 difference between capital gains 0% tax and the other. I mean, it's minor things, but when you're really doing the math, you want to be on the shy side of that.
Put a little cushion in there,
you don't want to have the situation where you got a little interest income you forgot to account for, and boom, now you're over the 70, and you thought you had 77.4 because that was the 12% ordinary income rate. So these are the kinds of things we're going to try to prep for, and that way when you're making decisions, you've got the tools to make the right decisions. Because I mean, you know, it's costs you a lot of money.
Yeah, exactly. This goes, so it's the same thing. And I've got clients and we're looking at maybe selling off some, whether it's mutual funds or stocks, individual stocks. It's one of the considerations. We want to make sure if we're stay in that bracket where it's 0
awesome.
tax, we want to take advantage of that. Or same from the other token. If we're in a 15%, we don't want to cross into what would be almost 24% tax, when we can just say, okay, well, I'll do so much this year and so much next year, and therefore I can minimize those taxes. All right, we've got a caller. We're going to go to Wayne. Welcome to the Retirement Report.
Yeah, good morning. Thank you for the time.
Yes, sir. How can we help this morning?
I hope you can answer this.
Okay, we'll give it a shot.
One of my family friends went on a game show and won a $40,000 car. What she wasn't aware of is before the car was delivered, she had to pay gift tax. She's wondering how that's going to affect her income tax when she files a return, because she's filing exempt and prepaying her taxes as she goes. So what's the best advice you can give me when you win a car on a game show?
Yeah, so, and this is always the downside. It's basically considered ordinary income tax, but you're not paying self-employment tax. You're just going to pay ordinary tax. So if she is in a lower bracket, is she single or married?
She's married.
Okay, so again, if her income and her husband and the game show profit is all under $77,000 plus the 24, so under $100,000, and Hank likes round two, under that $100,000, including those three things, she's going to pay 12% on it. If it kicks them over, she needs to consider 22% on the car just to be on the safe side. If I were her, I would set aside 20%. I would take the 40, set aside $8,000. Is she going to sell the car?
She's debating on what to do, because when they told her it's going to be over $10,000 before they could deliver it, she wasn't aware that, she thought she won a car.
Yeah, well, they're taking 25. They're taking a bigger chunk.
Well, where is she? She's here in Tennessee, right?
Yeah, she lives in Davidson County.
Yeah, they probably
But
have
where did she win the car?
Well, it's the favorite show on your channel of Price is Right.
Okay, but she was in a different state, right, where they're at?
In California.
Yeah. So one of the things, I'm not sure if she's getting hit with a California tax on that, or if this is just a withholding thing. If it's just a withholding thing, the 10 grand, then that means,
no, if she went into California, she'll have to do an out-of-state non-resident, and she'll have to pay California tax as well, which is at least 6%. So now she's looking at 26%, which is where that $10,000 is probably possibly coming.
The gift tax piece. If they have a gift tax out there, there's that. Here in Tennessee, there's not one. So she doesn't have to. If she had received a gift here, for instance, of $40,000, she wouldn't have to pay any gift tax. Ignite, and for that matter, if it's a gift, it wouldn't even be subject to necessarily income tax.
I mean,
but this is
the person giving the gift usually pays the gift tax, not the individual. Tax. So this is, even though they're referring to it as a gift tax, it's actually an income tax.
And so she's getting hit basically because of California in terms of the taxes. Gifts here wouldn't be a concern. So she's got, and they withheld $10,000 from, or she
has to physically come up with $10,000. Yes, she actually has to. That's what the whole. There was a big article on that because Oprah Winfrey years ago gave a bunch of cars away to individuals, and then the cars got delivered, and everyone was like, and so she turned around and paid the gift tax on them, or the delivery tax, whatever you want to call it. And she will apply that money when she files her taxes, so she may or may not have too much withheld or not. But the fact is, that's why most people sell them, to be quite honest. Most people will sell the vehicles because they can't afford $10,000. I mean, it's a great deal in some ways. I got a $40,000 car for $10,000, but when you think it's a free car, it's not free.
Not as much fun. Not as much fun. But I'd like, hey, okay, let me go ahead and pay 10 grand and get a $40,000 car. Not so bad. Or
but
pay 10 and sell it, and
they don't take installments. They don't take payment plans. They want all 10 up front. So that's not pretty.
Well, why don't they tell the people on the show when they win something? I mean,
I think in the small print they've got to have something.
Yeah. I'm guessing when you win something, they don't want to dampen your enthusiasm on TV right then. Let's save that for later. We'll save the bad news for later. Right?
Yeah, when they walk off stage.
Well, thanks to you, I get to save my Christmas Club account because I was going to loan her the money, but I'm going to give her your advice. I appreciate you helping.
No problem. Take care.
Thanks.
Thank you.
Thanks. Bye.
What a good brother
That's funny. There you go. That's very nice. One of the things here, when it comes to these to a windfall like that, there are some. Well, let me go back to this. Dr. Friday's seminars, we're going to take a break. When we come back, we'll get into that a little bit more, because one of the areas there has to do with other changes in tax law, not just the lower tax rates and that, but there have been things in Tennessee over the last 4 or 5 years, I guess.
Absolutely.
You know, the elimination of an inheritance tax,
Hall
the elimination
tax,
of gift tax, the reduction of hall tax. We'll talk about that a little bit as time allows. But first, we're going to take a break. So join us here. We'll be right back on the Retirement Report.
Are you